One, go.
Hola, buenos días. Les habla Carles Gaju, gerente de distribución institucional. Y en nombre de BICE Inversiones les doy la bienvenida a nuestro webinar. Hoy nos acompaña Yohee An, Senior Portfolio Manager de Mirae Asset Global Investments. Ella estará a cargo de la exposición de hoy que llamamos Mirae Asset Asia Consumption Update and Review, New Wave of Untapped Potential, donde se presentará acerca del fondo Mirae Asset Asia Great Consumer y sobre los diferentes riesgos y oportunidades que existen en el mundo de Asia emergente. Como saben, BICE Inversiones luego cumplirá 7 años representando a Mirae en la región y nos complace ya tener inversiones de varias de sus estrategias por clientes institucionales. Al final de la exposición, como siempre, tendremos tiempo para conversar con Yohee, por lo que pueden ir escribiendo sus preguntas en el chat y yo mismo las iré agrupando para responderlas al final de la presentación. Welcome, Yohee. Thank you for being here with us. You have our full attention. Please go ahead.
Okay, thank you very much for introduction. Today, I'm going to talk about the Asia Great Consumer Fund and actually some updates on Asia consumption story. So Asia has been transitioning from a world factory to the world's largest consumer in the global economy, considering its vast population and still low penetrations in most sectors. We believe this rising Asia consumer will be a multi-decade thing. So therefore, Mirae Asset launched this Asia Great Consumer Fund more than 10 years ago and has invested in the beneficiaries of Asia consumption growth, which is becoming the main growth driver for Asia and also the global economy. So since inception, the fund has kept a concentrated portfolio with around 30 to 35 stocks across sector that are selected from our bottom-up research. Before I move to more details of the fund, I will briefly explain why Asia consumption growth theme is attractive, and then I will talk about the impact of new policies and regulations in China on this theme. Then I will introduce some recent consumption trends that we are interested in and also invest in the fund. So for this section, my main point is Asia consumption is still so much underpenetrated. This Asia consumption growth may sound familiar to some of you since we have heard from the media that Asian consumers have emerged as the largest consumer in many segments. For example, as you can see from the left chart, the China's outbound tourist expenditure already outgrew the US in 2014, and it became more than double since 2016. But a more important chart is on the right side, showing the passport penetration in each country. This massive Chinese expenditure, which is more than double the US, were just made by only about 10% of population in China. The penetration is still this low. So if you assume that this penetration goes only up to a similar level to South Korea, the incremental number of first-time travelers almost equal to the number of the whole US population. If you look at this urbanization chart on the left, then you can realize that India's urbanization ratio is still under 35%, meaning that about 900 million people in this country did not even start to modernize consumption activities yet. On the right side graph, you can see how low even FMCG segments are in these emerging Asian countries. So therefore, here I want to emphasize that population really matters. These population charts must be familiar to most investors, I think. But more importantly, we need to understand how big the impact of a slight percentage increase of penetration. So it can be like huge from the perception, it can be huge from the perspective of investment opportunities. So for example, only 5% of increase in penetration in either China or India creates new consumers that are bigger than the UK population. Therefore, we need to be mindful that this Asia consumption growth is a multi-decade theme, which is a very long-term theme, and we are still staying in the early stage of that big growth path. Here, I also want to talk about the new policy direction in China because of two reasons. First, its new policy direction is very supportive of consumption growth. So Asia consumption theme is not only driven by increasing penetration, but also will be accelerated by the government's support. But second, on the other hand, actually, the lots of new regulations that were recently announced in China caused sharp correction of many stocks and the overall China market. The backgrounds of the recent regulation changes are these two policy directions in the orange-colored box. So first, the transition from high-speed growth to high-quality growth, and the second one is achieving self-reliance in science and technology. The first one is more related to the structural issues inside China itself. So China has shown the unprecedented speed of economic growth and urbanization ratio for the last 40 years or so. So during that course, the side effects have become more severe issues, such as the economic imbalance between investment and consumption, or the increasing inequality between the rich and the poor, and also the population, pollution issues. So the majority of the regulation recently introduced in China are to address these problems. So for example, the crackdown on the private education sector will narrow the opportunity gap between the rich and the poor, or the top tier city students and the lower tier city students. And also the lowered burden for private education will help support three-child policy as well. So this a series of the regulations in online sector, such as like antitrust law, also will protect the small-sized companies and benefit consumers. So the action to make online food delivery companies provide the riders with a social welfare system such as insurance is also essential for sustainable growth of the economy and society. So I just mentioned a lot of new regulations which were announced recently, and then we believe that this is actually to address these kind of structural issues that were kind of side effects coming from a very speedy economic growth and then urbanization trend for the last 40 years. And despite the near-term volatility of share prices, this new policy direction to pursue this high-quality growth pushes companies to be more socially responsible or environment, which is actually in line with ESG factors, where global investors got more interested in recent years. The second background of the recent regulations is related to China and US conflict. So trade tension that started in 2018 has expanded into other areas such as technology and capital markets. So the government is investigating the US-listed Chinese companies under the data security law. So the regulations related to this second one will be more unexpected and tend to be less company fundamental specific. So however, for most regulations that are to achieve the first policy direction, which is qualitative growth, and I believe it will improve the whole market efficiency and fairness and eventually benefit consumers despite the short-term volatility of share prices. So regarding the government plan to transition from investment to consumption as the economic growth driver, you can see from the left chart here that that China is still one of the countries where the imbalance between consumption and investment is the largest. So in 2020, last year in particular, the government effort to revitalize and stimulate the economy to cope with the pandemic, this imbalance actually got more extensive. As you can see on the right graph, the dark blue color is the contribution from consumption, and its role became actually almost zero in 2020. So therefore, the government seems very kind of committed to changing the direction of the policy from this year. And it is expected to support this consumption growth theme more strongly. China has issued 5-year plans every 5 years since 1953. So each 5-year plan included GDP growth target per annum, as you can see from the first table. However, for the first time in history, the government did not suggest any economic growth target for the 14th 5-year plan that starts from this year. They actually instead focused. They mentioned that they're going to focus on the qualitative sides to address more structural and long-term issues, as I explained earlier, which is quite different from the previous approach by focusing on the speed and scale of the growth. And also the annual NPC meeting in March suggested only 6% or higher for the GDP growth target for this year, when the market consensus was 8.4%. So it seems that they regret that most benefits from the stimulus measures they deployed in 2020 went to the local government or corporates, not to households. So that much lower than expected GDP growth target for this year may imply that they will focus on more long-term structural issues rather than support short-term economic growth. So this is just in line with the tone that we saw from the 14th 5-year plan. So by doing so, we expect that private households and individual consumers will get more benefits from this new transition that the government seems very committed to making. Thus, we believe that domestic consumption will play an even more important role in economic growth going forward. So from here, let's talk about the new trends, especially under the pandemic, and interesting themes as examples to that we are investing in for the fund. The first, obviously, the online engagement got deeper. Actually, the North Asian countries such as China and Korea were already ahead of developed markets regarding online service penetration. The younger generation have led this development, but it penetrated new consumers in the kind of older group by age, and also in lower tier cities by region through the pandemic. So it's not only new users, for the existing users as well, the time spending increased about 35% after the pandemic started. As the pandemic is becoming longer than initially thought, the consumers' new habits for online service are actually becoming a new normal. So this means online services will remain an important sector for Asian consumption theme even after the pandemic. So only actually the bottom up perspective though, it is noticeable that the consumption, the competitive landscape is starting to change to the opposite way in China and Korea. So as two upper chart shows, that China is moving to more multiplayer markets from almost a duopoly market, the government regulatory initiative, as well as innovative formats or the services led by newer and smaller players. On the other hand, in Korea, the online industries have been very fragmented, but few companies are finally starting to consolidate the industry. So thus, our stock picking has been changed to reflect these changes too. So currently, 2 Korean online names, Naver and Kakao, are included in our top 10 holdings. So this is another interesting change that we are seeing in China through the pandemic. So as the left-hand chart shows, the consumers trading up trend for premium products get accelerated last year because consumers care more about the health and other qualitative factors. So however, it doesn't not necessarily benefit foreign brands in China market, as you can see on the right-handed chart. So last year, when China was going through the pandemic, local brands still posted positive growth, while the growth of foreign brands turned negative. So we have seen gradual changes to this direction for the last 3 to 4 years, but the pace accelerated in 2020 much faster than we thought. So the consumer's old perception of foreign brands and local brands are actually changing now. So that is because the younger generations, such as millennials and Generation Z, are tech savvy. And meaning now they easily access all the detailed information of the products online and compare the apples to apple before they purchase. So in the past, the foreign brands used to just sell at a premium once it enters the market, but sometimes regardless of the product quality. But now it is not the case anymore. So this, more importantly, the Chinese younger generations, young consumers' pride in the country has supported the local brands and local brands to rise further. So since the US and China tension became severe in 2018, they have shown their kind of patriotism online more and more, and this kind of environment has been supportive of the local brands. Well, as long as the quality is good. So this trend became sturdier last year as they became even more proud of being Chinese after seeing faster containment of the virus than any other countries. So for example, the local sportswear brand Li-Ning is very symbolic for nationalism because the founder is China's first Olympic medalist. So this is not a new company at all. It was founded about like 30 years ago, and it made lots of mistakes and learned lessons for the last few decades. And finally, it is rising as a leading brand in sports and leisure wear industry. Well, now the celebrities in China also tend to choose local brands when they are seen in public too. So besides this sportswear industry, we also see the emergence of local brands in various sectors, even including baby products, not to mention smartphones or other home appliances. So the upper right table shows that 2 out of the top 5 cosmetic brands selling the best on online promotion day are already local Chinese brands. So Chinese companies have made lots of efforts to enhance product quality for the last several years. So the perception of made in China or made by China products is not just a cheap copycat anymore. Plus, the patriotism of the young consumers is boosting the emergence of lots of the local brands. The next interesting and important trend is the new wave in tourism and luxury consumption. So you may have heard that the Chinese are the biggest consumers in the global luxury industry already. And out of this Chinese luxury spending, about 70% or higher was spent out of China when they traveled overseas. However, as you can see on the top right graph, the more than 70% of luxury spending was done inside mainland China in 2020. So this big jump was, of course, owing to 2 reasons. As first is the pandemic kept people from outbound traveling, of course. and the domestic tourism replaced some travel demand. And second, the Chinese government took advantage of this situation to bring the luxury spending of its middle-class consumers back to its own market. So they announced much larger scale than expected relaxation in duty-free policies. So it has tripled the annual spending limit at duty-free shops, and the online purchase for the following 6 months after a visit to an offline shop has been allowed to when they relax the policies. And the limitations on the number of the items they can purchase were also lifted or kind of relaxed in most categories. So as a result, duty-free sales growth in 2020 last year almost doubled, while the overall retail sales posted negative growth due to the pandemic, as the bottom left chart shows. So this more, this move accelerates the recent changes in the travel habits of young consumers. So recently, they would spend less time for good shoppings and spend more time for experiences when they are traveling overseas. Maybe it was influenced by their usage of SNS, because the experiences are better to share on social networking services. And with this policy relaxation in duty-free industry, so now consumers are expected to spend more time and more money at onshore duty-free shops before they get on the plane, even if outbound tourism is resumed post-pandemic. The pandemic triggered the change of the consumers' luxury spending habits, and it's expected to be boosted by the government policy relaxation going forward. So repatriation of luxury consumption is helpful for China's economic transition to a consumption-driven economy, and we are positive on the beneficiaries of this new trend. Besides the sectors that I just talked about, we also see good investment opportunities in other sectors. For example, the healthcare expenditure to GDP is so low in emerging Asia, even compared to non-Asia emerging markets. India's healthcare spending per capita is only $200 US, while OECD average is almost like $4,000 US. As consumers are becoming more health conscious due to the pandemic, so we are positive on hospital and pharmacy businesses, and also the online healthcare businesses rising in emerging Asia now. Retail banking penetration is also very low, as you can see from top left chart. So we are positive on high quality leading consumer banks in more developing areas such as India, Indonesia, and then also we are actually positive in China as well. So for example, HDFC Bank business, that's a high quality bank, consumer bank in India. So HDFC Bank business has been much more resilient than market expectations during the pandemic, as it continued to tap new consumers in lower tier cities successfully. So now I'll move to fund information to share more details of the current portfolio and the impact of the recent market volatility. This fund has a consumption thematic approach, but we do not stay in consumer sectors only. So as consumer spending patterns keep changing, so we can see more and more beneficiaries of consumption growth beyond traditional consumer sectors. So also we have a benchmark, which is a broad index, but it is just mainly for reference only. We actually manage this fund like a benchmark agnostic strategy with a bottom-up and high conviction portfolio. So these country and sector allocation, these sector allocations are just the result of bottom-up stock picking. So currently, China and Hong Kong together account for about 47% in the fund, which is almost in line with benchmark. And we have the largest overweight positions in Korea and India. On the other hand, Taiwan is the biggest underweight market because we prefer to invest in more direct beneficiaries of consumption growth rather than indirect ones, including IT or hardware components. So for sector allocation, about 57% of the fund invested in consumer discretionary and staples. And for the rest, we invest in communication services and financials and healthcare, etc. So for example, main holdings in the financial sector are consumer banks, not corporate banks. And the names in the material sector is a paint company. So we have limited position to IT hardware or pure commodity names such as energy, utilities, and materials. If you look at top 10 holdings here, the first and third names are Korea online companies. And the second one, Li-Ning, is the local sportswear brand in China that I just introduced earlier. So overall, five China Hong Kong names and 3 Korean names and 2 Indian names are included in this top 10 holdings. And top 10 holding, these 10 names contribute about half of fund NAV. So regarding the fund performance, the fund has generated meaningful alpha since inception in 2011. However, if you look at this year-to-date number, the fund has underperformed about 900 bips. That's a big underperformance. And also out of this 900 bips, actually about 500 bips was all from a month of July, only from last month. Despite market rotation into value and cyclical sectors this year, actually the fund has defended well until June with a good stock picking, such as Korea Online and Chinese sportswear names till the end of June. However, when the details of the new regulations in Chinese, the education sector were released in the middle of July, the share prices of education and online names corrected very sharply due to its surprisingly drastic regulations. Although we reduced the positions of China education and online names more than half over the late last year to early this year, but the fund had a negative impact due to the remaining position. And this can, I think, this can explain about 1/3 of this underperformance. And for the rest, I think the second reason behind this underperformance in July is the taking profit actions for the outperformed Chinese names, even in the sectors where we do not see regulatory risks, which was triggered by the investors' concerns on the Chinese government intervention and the negative sentiment on the overall China market. And third reason is the resurgence of the COVID-19 cases in China. So new confirmed cases started to rise in various cities, and the situation is becoming more serious than the previous outbreak in January. So if you look at this performance attribution by country, then you can see that about 700 bips out of 900 bips is coming from China and Hong Kong. So we deleted in July, we deleted the education names and US listed Chinese names under the recent regulatory risks. However, for the rest of the positions in China, which detracted our performance, so we are still very constructive and positive on their outlook. While the government pushes the new regulations hard, but also they also support other areas more strongly too. So Asia consumption growth is a multi-decade, the long-term theme. So market volatility, like now, gives good buying opportunities for the high quality companies that lead new consumption growth. So as a bottom-up stock picker, we will take current market correction and volatility as a buy and dip opportunity for high conviction names, especially in the sectors that receive the government support rather than the negative regulations in China. So also, we believe a series of recent regulations to achieve sustainable high quality growth will improve market fairness and efficiency, and actually eventually it will benefit consumers as well. So despite the short-term volatility, maybe for the next 1 or 2 quarters, because of some adjusting period of the companies, but I think this kind of again, this kind of volatility will be a long-term opportunity. So besides China, we also see good investment opportunities in other countries such as India, Korea, and ASEAN that benefit from new consumption pattern driven by the long-lasting pandemic or the younger generation consumers. So just like you can see here, since inception, all the outperformance actually came from selection effect, which means it was all driven by stock picking rather than top-down allocation by country or sector. So now I know a lot of investors, they have concerns on the regulatory risks in China, and so from top-down perspective, it looks like there are some risks, but as I mentioned earlier, that means some other areas we are going to see even stronger support and a stronger driver for kind of the next consumption growth, the trend. So I think in July, even our fund also got sharply impacted from this kind of events in the market. But I hope investors, they can understand that this is actually, it's going to improve the whole society and economy quality, and then it's going to eventually actually benefit and push the companies to be more like socially responsible and environmental, which are actually in line with the overall the ESG trend. So I think that education sector or the online sectors that we deleted already, I can say that it's going to, we are going to see some recovery from that, because that's a little different story. But 2/3 of this underperformance actually came from the sectors of which fundamentals are still very constructive and very strong, and then they even actually have the support rather than regulations actually. So 2/3 of underperformance actually came from the kind of strong areas. So I think hopefully I want to emphasize that this kind of market volatility is always giving us a good buying opportunities for the kind of the good companies from bottom up perspective. So lastly, in terms of the valuation, because of the recent correction, actually fund valuation also got lowered. So previously it was trading at around 1.1 or 1.2 of PEG ratio, but now it's got lower to about the 0.85 to 0.9. So again, from the valuation point as well, I think now it's becoming more attractive. So I think I covered pretty much everything. So if there is any questions from the audience, then I want to answer. Thank you very much for taking the time to listen to my presentation. Thanks.
Thank you, Juhi. This was a great presentation, and we have several questions that you already mentioned a little bit, but maybe we can go a little bit deeper on your thoughts about, for example, what you was just mentioning regarding the current context in China. So you were mentioning that, do you think this is a good entry point, a buying opportunity, but what would you say to some investors regarding they should see this more cautiously, this regulation changes, or or it's for sure a buy opportunity as a whole. If you already touched a little bit on that, but if you could elaborate a little bit more on that.
So I would say this way. So Chinese regulation and actually the magnitude is much deeper. Then they are much more serious about the changing. They're much more committed to making these changes from this year. So I would say some areas where we are going to see more regulations, which means some like inequality related sectors, like housing, property sectors, or healthcare, or like education sectors. So that sectors maybe still, I would not say that now it's a good buying opportunity yet, because I think on the more and more regulation related talks could come out. So yeah, nobody can say for sure in terms of the time frame. But I think now the media and then the market participants, they are now talking about the negative regulations could target mobile gaming. So that could be another next one. So I think more and more regulation could be coming out. So I think my point is this kind of the uncertainty is going to create a very good buying opportunities for right names, not overall index, not overall market. So of course, this kind of the Chinese government intervention could make global investors to increase their risk premium, right? When they're looking at the Chinese market. So I cannot say that this is a kind of the bottom of the overall China index, but going forward, so stock picking is going to be more and more important, because some areas definitely they are going to give even stronger support. So as their regulation was stronger and the magnitude was deeper, that means their support will be stronger too. So for example, recent weeks we deleted some education names, although there was only 1% in the fund, and also some online names, especially which is the US listed ones. But at the same time, we added more weights on sportswear companies, or some EV, electric vehicle related ones, or some other areas where we are expecting to see stronger support from the government. So in that case, then I think, yeah, this could be a very good buying opportunities for the kind of specific names or specific subsectors. So yeah, going forward, definitely the bottom of stock picking will become more important. And then I do not want to say this is the end of the world in China, because some people are very scared about these regulations and they just want to avoid this China. But now, still now the China is full of opportunities. So as long as you pick the right stock.
Was thank you for this clarification. That was really really good to hear that. Also regarding maybe these sectors that you were just mentioning, also that are going to receive maybe more attention and even from the government, these sectors relate to the new policy priorities, like the neutral carbon target, clean energy, solar panels. You just mentioned the AV value chain. So could on those sectors, do you think it's also going to be more specific names? So you should target some names, or all the whole sector is gonna get beneficiated on this?
Well, our fund invests in only about 30 names actually. So we want to keep just figuring out which company is going to be a leader in that segment. So yeah, we do not just buy whole industry or theme or sector. So we want to actually find what management is going to have a right strategy, right with a kind of very strong competitiveness in the industry. So the first, of course, we want to look for more opportunities in the sectors where we are going to see some support from the government. But at the end, when we decide to invest, and we prefer to invest in kind of more kind of high quality and more competitive few stocks rather than just a whole sector. Yeah.
Perfect. And continuing with the questions about the sectors, we have two more questions on that regard. What's happening in the pharmaceutical sector? Are you seeing any regulation by authorities on that sector?
So pharmaceutical sectors, we have seen a lot of regulations as well, but I think at this current level, we believe that at this level, because generic, mostly the regulation was to push down the prices of generic drugs. And because at the time, previously, the prices of the Chinese generic drugs were much more expensive than the other global average. But now, after several times of price cuts, now actually the price level is kind of similar to global the average. So we do not think that there will be more harsh the regulations to push down the price going forward, because now, now the pharmaceutical companies, they make less margin from making generic the drugs, right? So they have to be more creative now to make kind of new drugs, or they have to move to like a biotech and kind of new areas. That's what the government wants. They don't want them to just stay with the generic drugs with higher margin. So yeah, that was painful for the last few years, right? As a pharmaceutical, if you're a pharmaceutical company, that was painful, but actually fundamentally that's a right step, from a big picture. So I think the Chinese government's regulations are all kind of like that. Of course, some political issues or some ideology issues could be kind of mixed in all the kind of decision making process a little bit. But if you look at the big picture, then actually this is the right time for them to address this. Is a lot of like structural side effects and issues to drive whole industry growth and then whole investment to the right direction. So yeah, so coming back to your questions, I think the pharmaceutical names also has been under pressure from this regulatory uncertainty. But going forward, I think we could see some new opportunities for some companies who can be more innovative for the new drugs, not generic drugs, or some bio-related drugs. Yeah.
Great, thank you. Thank you. Another sector about the consumer the Asian consumer companies, how the shortage from semiconductors have affected them.
So that affected mostly auto companies. So in our fund, we are holding four auto names. So one, the Hyundai Motor, Geely, BYD, and Maruti in India. So so far, actually, I remember first quarter, second quarter, first half, there are a lot of like serious concerns on that the auto semiconductor chip shortage, but it turned out actually the leading companies in auto sector, they actually managed that pretty well. So in terms of the impacts in the margin was kind of low single digit, and the TSMC, who is the biggest chip maker, already mentioned that they could meet the demand by end of January. End of June. But of course, if you think about the supply chain, it will always it takes like 5 or 6 months until it reaches to the auto OEMs. So probably we are going to see some, this kind of shortage problem will stay in the market until maybe end of this year. But fundamentally, I think already after that, we are going to see the better situation, and then the worst is behind us. That's what we are thinking now.
Perfect. I know that there's a question. I don't know how to address it, but it's about the A shares and H shares and the ADRs. I know that you are a bottom-up investor. But which one of these share classes do you see more value on the mid and long-term future?
It's okay. First, so just like you mentioned, actually, as long as the fundamentals are okay, and then we did not care about the listing where they are listed. So in the US as an ADR or Hong Kong or the Asia, but after we saw this, US and China tension got expanded into capital markets as well. So now the kind of uncertainty and then potential risks for the US listed Chinese companies are actually increasing. So like, for example, Didi Chuxing, right? They got listed in the US. Right after a few days after that, China started to investigate the company with the name. Under the name with like cybersecurity law, right? So that's that kind of regulation, which is related to the second box that I mentioned during the presentation, which means that's related to like US-China tension-related ones. I think that kind of risk and uncertainty is beyond our expectation. It's more, it's not like company fundamental oriented or specific. So we also deleted our position of China, the US listed Chinese one. So the US market, obviously, I prefer at this moment. I prefer the Hong Kong listing or Hong Kong listed or Asia listed companies. But between Asia and Hong Kong, I would not say that I prefer Asia. I prefer Asia. I wouldn't say that. It really depends on the valuation and just individual companies' fundamentals. So it's indifferent between the two. Yeah.
Perfect. Thank you very much. I think we don't have more questions. So thank you very much for taking the time to be with us today and presenting very well the fun and the opportunities also that we are facing there. So thank you very much. Y muchas gracias también a los asistentes por estar aquí hoy día y acompañarnos en el día de hoy. Muchas gracias.
Thank you. Thank you very much for having me today. Have a nice day. Bye-bye.
You too, Juhi. Bye-bye. Thank you.